Most people think markets react to bad news. They don't. Markets react to what quietly changes beneath the surface, long before the headlines catch up. By the time the news feels obvious, prices have already moved. That's why the most dangerous moments in finance rarely look dramatic at first. They often look confusing, disconnected, like noise. A stock drops sharply even though earnings look fine. A safe haven asset spikes, then collapses within hours. Currencies move in ways that don't fit the story you're being told. When that happens, the instinct is to explain it away. Just volatility, just profit taking. Nothing fundamental changed. But history shows something different. Markets don't fear bad outcomes. They fear shifts in confidence, changes in constraints, and limits becoming visible. They fear moments when the rules people assumed were stable stop behaving the way they used to. The purpose of this discussion isn't to predict a crash. It isn't to assign blame, and it isn't to sell fear. It's to slow things down and examine what actually changed, how quickly it changed, and why experienced market participants paid attention, even if the broader public didn't. Because understanding why markets move matters far more than reacting to how much they moved. Let's start by establishing the facts, calmly, precisely, and without interpretation. Between Wednesday, January 28th and Friday, January 30th, 2026, multiple major asset classes experienced rapid and unusually synchronized price movements. Monetary policy event. On January 28, 2026, the U.S. Federal Reserve concluded its first policy meeting of the year and left interest rates unchanged, citing ongoing inflation pressures and labor market conditions. This decision paused the rate cut trajectory that markets had previously anticipated. Equity markets. On Thursday, January 29th, U.S. equity markets declined sharply. Microsoft shares fell approximately 10% in a single session, resulting in an estimated $357 billion reduction in market capitalization. Other large-cap technology stocks also declined, contributing to broad index weakness. Futures markets experienced elevated volatility, and intraday trading volumes increased significantly compared to the prior week. Precious metals. Gold prices reached an all-time nominal high during the week, exceeding $5,300 per ounce, before reversing sharply. Within approximately 18 hours, gold declined by roughly 10 to 12% from its peak. Silver prices fell by double-digit percentages over a similarly short time frame. These price moves occurred after a period of strong upward momentum throughout January. Currency markets. The U.S. dollar weakened against a basket of major currencies over the same period. The move represented one of the sharpest short-term declines in the dollar in recent years, occurring across multiple trading sessions rather than a single event. Fixed income. U.S. Treasury yields moved higher following the Federal Reserve decision. Long-dated Treasury yields rose notably compared to levels observed earlier in the month, indicating a repricing in the bond market. Public finance data. As of early January 2026, total U.S. federal debt stood at approximately $38.43 trillion, according to congressional data. The year-over-year increase was approximately $2.25 trillion, implying an average daily increase of roughly $8 billion. Net interest costs on the debt reached historically high levels in fiscal year 2025, exceeding several major federal spending categories. These events occurred within a compressed time window, affecting equities, commodities, currencies, and bonds simultaneously, and represented a marked change from market behavior observed earlier in the month. What matters most about the recent market moves is not the size of the price changes, but how many markets moved at the same time and for similar reasons. This was not an isolated equity sell-off, a commodity correction, or a currency fluctuation occurring independently. The movements occurred across equities, precious metals, currencies, and bonds within a compressed time frame, which suggests a shared underlying driver rather than asset-specific news. At the first-order level, several mechanisms were visible. The Federal Reserve's decision to pause rate cuts altered expectations for the near-term cost of capital. Treasury yields adjusted upward, affecting valuation models across equities. Highly liquid assets experienced sharp selling as volatility increased and risk limits were tested. Precious metals, which had seen strong inflows earlier in the month, reversed rapidly as positioning shifted. These first-order effects are mechanical. They occur whenever assumptions about interest rates, liquidity, or policy paths change. The second-order effects are more important. Second-order effects involve behavioral and structural responses, particularly among large institutional participants. When multiple asset classes reprice simultaneously, it often reflects a reassessment of constraints, such as how much leverage the system can absorb, how stable policy expectations really are, how dependent asset prices have become on specific macro assumptions. The sharp reversal in gold and silver following new highs illustrates this dynamic. The initial rise reflected strong demand for assets perceived as defensive. The subsequent decline reflected position adjustments, not a sudden change in the underlying supply or industrial demand for those metals. Similarly, the decline in large-cap equities occurred without corresponding deterioration in short-term operating fundamentals. This suggests that the repricing was driven by discount rate assumptions and risk management decisions, rather than company-specific events. Another key aspect is timing. The speed of the moves indicates that many participants were positioned in similar ways. When positioning becomes crowded, even modest changes in expectations can lead to outsized price responses, as market participants adjust simultaneously. Finally, the currency and bond markets provide important context. Rising long-term yields alongside a weaker currency is not typical during periods of strong confidence. While such configurations can occur temporarily, they often signal tension between monetary policy, fiscal conditions, and capital flows. None of this implies an imminent crisis. It does suggest that the margin for error has narrowed. When markets become more sensitive to policy signals and liquidity conditions, volatility tends to increase. Not because outcomes are known, but because uncertainty about limits increases. Understanding these cause and effect relationships helps explain why the recent moves matter beyond a single trading week. They reflect changes in how risk is being priced, not just what assets are being traded. Periods like this feel unfamiliar in real time, but history shows that markets have experienced similar configurations before, not identical outcomes, but comparable preconditions. One common feature in past episodes of heightened volatility is a shift in expectations rather than a collapse in fundamentals. For example, during the 2013 taper tantrum, asset prices moved sharply not because economic conditions deteriorated, but because markets adjusted to the realization that monetary support would be less predictable than assumed. Bond yields rose quickly, equities wobbled, and capital flows reversed in several regions. The episode resolved without systemic failure, but it demonstrated how sensitive markets can become when policy assumptions change. Another reference point is late 2018, when U.S. equities declined sharply following tighter financial conditions. At the time, economic data remained relatively stable, but markets reacted to a perceived tightening of liquidity and policy flexibility. Again, the stress came from expectations and constraints rather than immediate economic damage. Looking further back, the early 2000s provide a different example. In that period, equity valuations adjusted downward after years of excess, while monetary policy attempted to cushion the transition. The key similarity was not the outcome, but the reassessment of what assets were worth under different assumptions. What these episodes share is a sequence, a long period of stability or accommodation, a shift in policy or financial conditions, a rapid repricing as participants adjust positioning, elevated volatility while markets search for a new equilibrium. What matters most is what happened before outcomes were known. In each case, uncertainty increased because constraints became visible. Participants realized that certain supports, liquidity, policy predictability, or valuation assumptions were not unlimited. What is different today is the starting point. Current conditions include higher overall debt levels, greater reliance on policy signaling, faster information transmission, more synchronized global markets. These differences do not determine outcomes. They simply affect how quickly markets react and how widely adjustments propagate. History is useful here, not as a forecast, but as a filter. It reminds us that sharp multi-asset moves do not automatically lead to crisis, but they do indicate periods where risk must be assessed more carefully, assumptions revisited, and patience emphasized. Understanding this helps keep analysis grounded when emotions rise. At moments like this, professional analysis shifts away from prediction and towards scenario construction. The objective is not to guess what will happen, but to understand what conditions would need to change for different paths to emerge, and how markets might respond if they do. Below are three plausible scenarios, framed probabilistically rather than definitively. Bull case, stabilization, and reanchoring. If inflation data over the next several months continues to trend lower, and if labor market conditions soften gradually rather than abruptly, and if financial conditions ease without reigniting inflation expectations, then markets could interpret recent volatility as a temporary repricing rather than a structural shift. Under this scenario, Treasury yields stabilize or decline modestly. The US dollar finds support as capital flows normalize. Equity markets recover as discount rate pressure eases. Volatility subsides as positioning resets. This outcome would likely require clear communication from the Federal Reserve, absence of new fiscal or geopolitical shocks, evidence that monetary policy remains credible and flexible. Importantly, this scenario does not require strong growth, only predictability. Base case, prolonged adjustment and higher volatility. If inflation remains uneven, and if growth slows without a clear recession signal, and if policy remains data-dependent with limited forward guidance, then markets may enter an extended period of range-bound movement with elevated volatility. In this case, asset prices fluctuate as expectations shift frequently. Liquidity becomes more selective. Valuation multiples compress gradually rather than suddenly. Market leadership rotates rather than broadens. This is often the most common outcome historically following sharper pricing events. Markets spend time digesting new information, adjusting positioning, and testing levels without a decisive trend. For investors, this environment rewards risk control, diversification, patience rather than conviction trades. Bear case, loss of confidence and policy constraint. If inflation reaccelerates or proves resistant to policy tightening, and if long-term interest rates rise despite central bank efforts, and if fiscal dynamics begin to affect market confidence, then markets could experience a more sustained repricing of risk. In this scenario, equities revalue lower due to higher discount rates. Credit spreads widen. The dollar may weaken despite higher yields. Defensive and real assets outperform on a relative basis. This outcome would not be driven by panic, but by constraint. Markets recognizing that policy options are limited. It is important to emphasize, this is a conditional scenario, not a forecast. Its probability depends entirely on whether those conditions emerge. Why scenario thinking matters. Professional risk management does not rely on certainty. It relies on preparing for multiple outcomes and adjusting exposure as probabilities change. Markets rarely move in straight lines. They evolve as information changes. The purpose of scenario analysis is not to be right. It is to avoid being unprepared. In periods of elevated volatility, the most important discipline is knowing what to watch and what to ignore. Rather than reacting to headlines or short-term price swings, I focus on a small set of indicators that reflect liquidity, confidence, and constraint across the system. 1. US Dollar Index, DXY. The dollar provides insight into global capital flows and relative confidence. I'm not watching daily fluctuations, but trend persistence. A sustained move lower or higher over several weeks tells more than a single volatile session. The key question is whether the dollar stabilizes as risk adjusts or continues to weaken despite rising yields. 2. Treasury yield curve, especially the 10-year and 30-year. Long-term yields reflect how markets price growth, inflation, and fiscal risk. What matters is not just yield direction, but whether yields rise or fall independently of Federal Reserve messaging. Divergence between policy signals and market pricing often indicates changing confidence. 3. Inflation data, CPI and PCE. These reports remain central because they directly influence policy constraints. I focus less on headline numbers and more on trend consistency, particularly in services and wage-sensitive components. One data point rarely changes the picture. A pattern does. 4. Market liquidity and elevated volume during declines can indicate forced repositioning, while declining volume during rallies may signal fragile recoveries. Liquidity conditions often change before price direction becomes clear. 5. Positioning and open interest. In futures and options markets, changes in open interest help distinguish between new conviction, short covering, de-risking. This matters because markets often move fastest when positioning is crowded, not when fundamentals change. 6. Cross-asset correlations. When equities, bonds, commodities, and currencies begin moving together, it suggests stress at the system level rather than isolated asset-specific issues. A return to lower correlation often signals stabilization. The purpose of monitoring these indicators is not to predict turning points. It is to update probabilities as conditions evolve. Good analysis is iterative, not reactive. Periods like this test more than portfolios. They test discipline. When markets move quickly across asset classes, the instinct is to act immediately, to explain, to predict, to position aggressively. Professional experience suggests the opposite approach often works better. This is not a moment for certainty. It is a moment for observation, patience, and risk management. Nothing discussed here is a prediction, and none of it should be interpreted as investment advice. It is simply a structured way of reading the market based on confirmed data, observable behavior, and conditional scenarios. Markets adapt, policies evolve, outcomes change. What matters most is maintaining flexibility, avoiding overexposure to any single narrative, monitoring the indicators that actually drive liquidity and confidence, and allowing probabilities to guide decisions rather than emotion. Volatility does not automatically signal danger, but it does require attention. For now, the most productive response is to stay grounded, remain diversified, and let evidence, not headlines, shape the next move. That is how I'm reading the market at this point in time.